Welcome to Forte Asset Solutions market commentary for the year 2012. This actually marks my 10th year of selling financial services businesses as well as commentating on a 6-month basis. As reported in the July 2012 report, we saw the stabilization of prices. However, the big surprise was actually at the end of the year. In the last quarter of 2012, the amount of businesses coming to the market substantially increased, and as much as 300% increase on any previous period of time. What that meant for Forte is that I had more new listings in 2 months than I had in the previous 18 months. And the reason for that increase in supply was largely due to confidence. When we broached the 4,500 all odds and also recorded 19.7% gain for the calendar year, confidence was restored in a number of ways. Firstly, that the market, the revenue, if you sold your business, was likely to be, if not as it is currently, but more than likely, it was going to be actually higher. What it did for many principals was actually reinforce that sticker price that they had in their head of what their business was worth prior to the GFC. And so all of a sudden they were able to execute on their retirement plans. The market had been largely starved of supply. What we had seen in the last 2-3 year periods were people that were selling down C and D type clients. One institution reported that they'd done over 200 of those transactions in the last 2 to 3 years. And it was largely with principals that were selling down for a number of reasons, but predominantly was to take something off the table, to supplement their lifestyle, or to pay down debt. Revenue was not only impacted by negative market returns, but also because of the increasing cash reserves. On average, most practices have somewhere north of 30% of total assets in cash. And so as we see the movement from cash into other investments, we'll see increasing revenue. Buyers also see this as an opportunistic time to acquire as well, so that they can participate in the new advice fees. FOFA has been a contributing factor in some of the sales, whereby the principals have recognized that they have to change their business model to a fee for service, and have done a personal audit and said, I just don't have the energy for it, and so put their hands up. But it's only a few. It's nowhere near the exodus that some market commentators foresaw. So we're not seeing it now, nor do I see that coming through post July 2013. I think that has happened is because of the shift on the prices, market environment, but also I do recognize that Forte's own brand has substantially increased as well. This is due to a competitor's failure and subsequent departure from the marketplace, and also because of the many marketing activities that has contributed to the rising of the Forte's brand. And so we have seen a shift on the supply side, but I believe it's largely due to the market environment that we're now operating in. Demand is still a constant and is still largely unsatisfied. There's been an absence of organic growth, and while we're starting to see green shoots now, it's still principals are recognizing that for success, there really is a requirement for size and scale. We're seeing substantial support being offered by institutions in the way of finance, in transition teams, and also institutions that have been acting as brokers. So they may acquire on a 3 times basis, sell on a 2.75 times basis, and with beneficial type finances. We've seen continuing lower interest rates, which makes the financial metrics just even more appealing for acquisition. FOFA did have a negative impact on buyer demand, but that was largely in the period immediately post the Ripple report. Subsequently, we've actually seen some clarity in the legislation and what environment we're likely to be operating in post 1st of July 2013. And the reality is that whilst opt-in may be a risk factor, it's largely negated by the buyer's confidence in their own value proposition. They firmly believe, and rightly so when you have a look at their business models, that they have the ability of engaging clients, and that's what they're very confident about within any market environment. Volume overrides, which has been the fuel and the lifeblood of our industry, still continues for those clients that prior to the 1st of July 2012. What I've also seen in the last 4 months of the 2012 and continuing into 2003 is the emergence of new buyers. These are buyers that have remodeled their business and have in-house products and are looking to acquire and transition existing firm into their own platforms. We're also seeing the emergence of private equity coming into this market, and I believe that is opportunistic, that they can see suppressed prices, suppressed revenue, and have the desire to get into almost like a ground floor of financial services at this stage. We're also seeing family offices that have been providing at the very high net worth, deciding to extend their service offer down to high net worth, say from 1 million to 10 million type clients. And I also expect that we'll see a resurgence in listed entities looking to acquire and come back on their acquisition trail. 2012 was the first year that I recorded no EBIT sales, with the exception of internal succession or partner valuations. The reality is, whilst EBIT may not have been used, it's still the second valuation methodology. The profitability of the practice will actually determine the multiple that, even if it's on recurring revenue, will be afforded. For example, if a $200,000 business is acquired at $600 and interest and principal is $60,000, assuming at 10%, then the profitability of that business should be greater than $60,000. If it is greater than $60,000, therefore we have positive cash flow, it will be afforded a higher multiple. If, however, the EBIT, adjusted EBIT, is less than $60,000 in that example, it will be afforded a lower multiple. So whilst EBIT is not prevalent, it is still part of any assessment of valuation. So for the year 2012, as nominated earlier, we've seen the stabilisation of prices. For self-managed super fund advice fees, somewhere around about the 3 times. Self-managed super fund administration, 1 times. That's why many are rolling their administration fee and bundling it with their advice fee so it can be deemed to be, and rightly so, recurring in nature. General insurance, 1.9 times. Risk practices, 3.5 plus times. Normal financial planning, 3 times. C&D clients, we're seeing probably around about 2.75 times. And I expect some downward pressure on that end of book sales. Accounting, it depends largely on revenue segmentation. I returns about 60 cents to the dollar. On compliance, BAS work 80, business advisory about dollar for dollar, and also self-managed super fund administration or audits around about 1 times. So what we've seen is really that stabilization of prices. Going into the future, I think that we're likely to see downward pressure on the C&D clients as opt-in really comes in and makes its impact felt. I think we'll still see substantial movement and reshuffling within mid-tier dealer groups who need to bring in-house products but are struggling given the diminishing returns due to the volume overrides being deemed to be conflicted revenue. I think that we will still see significant M&A activity with larger institutions acquiring distribution. All in all, I think we're coming back into normal market conditions. It appears that as an industry we have weathered the storm and we're emerging, I believe, with better businesses that are a lot more client-centric. It is my sincere hope that 2013 is going to be significantly brighter than the previous 4 years, and I wish you all the very best. Thank you.